Right now, as you're watching this, there are 66 American banks on the Fed's secret problem list. Banks sitting on $400 billion in losses and over $1 trillion in commercial real estate loans that need to be refinanced at interest rates that could bankrupt each one of the borrowers. So if you've got money in a bank account, you own a bank stock, or you have some sort of 401k or pension fund, what I'm about to show you could save you or make you potentially a fortune. So in the next few minutes, I'm going to break down exactly what the Federal Reserve just did, why it triggered the largest banking crisis since 2008, and most importantly, the 5 specific moves you need to make this week to protect your money and profit from what's coming. My name is Felix Prehn, I'm an ex-investment banker, and I'm on a holiday, but I was reading a paper on it this morning and I thought, I don't think people understand this. I thought I'd share it with you because our mission here is very simple. We want to make 1 million people financially free, and that's a big mission. I'm very excited for that. That's also why I'm the founder of the Goat Academy, where we've helped over 20,000 students so far learn to invest intelligently. And I'm also the co-founder of TradeVision.io, a platform that gives you and me, retail investors, the news and the data that were once only available to institutions. So I'm not here to sell you fear. I'm not here to make this a doom and gloom video. I'm here to give you facts, data, and action steps. Because while mainstream media is asleep at the wheel, smart money is already moving. And by the end of this video, you know exactly where they're moving it and why you may want to think about that too. So let's get into it. Okay, for a moment here, imagine you're playing a video game and the difficulty level keeps changing. That's basically what the Fed has been doing to the entire economy for the past 3 years. Back in March 2022, slight history lesson required. Inflation was out of control. Your groceries cost more, gas was insane, everything was getting more expensive. So the Fed did what they always do, they raised interest rates. Think of interest rates like the price of money. When rates go up, it costs more to borrow, and that slows down spending, which cools off inflation. And the Fed has raised 11 times in a row. They went from basically 0 rates to over 5%. The highest level that we'd seen since 2001. Remember what happened back then, right? So it was a very massive, a very aggressive move. And then something changed. Inflation started cooling down. The Fed got nervous about choking the economy hard. So they cut rates in September 2024 by 50 basis points. That was a big cut just before the election. And then they did 2 more cuts. So by the end of last year, rates were back down to like 4.25%. Now, fast forward to right now, we just got another cut in October. We're now sitting at a 4% interest rate. So the Fed is easing. They're making money cheaper again. Now you might be thinking, that sounds good, right? Lower rates are good for the economy. And you'd be partially right. But here's the problem. The damage was already done. Now, before we dive deeper into this, because this is so freaking important, I want to give you one better, actually 2 better. To start with, there is a free workbook that comes along with this video, because there's a lot of information here. So we're going to put together a workbook for you so you can actually print that off and you can read that in your own time. And there's a link down below, felixfriends.org/resource. And then number 2, a lot of you might be thinking, well, how do I find stocks to actually benefit from this setup? Well, you'd need to know Wall Street's rules for stock picking. So would it be nice to have that? Yes or no? Well, I'm going to give you that too, but not in this video because it would make us insanely long. I'm going to run a live training on this very Saturday at 9 a.m. New York time, which is about 2 p.m. London, I think. And we're going to go for like an hour and a half or 2 hours because this time is really important. And I want you guys to be equipped with some real tools there. So you can get yourself a free seat for that at felixfriends.org/training. The link is also down below, felixfriends.org/training. But let's get back to the story here. The most interesting part. The Fed doesn't just control the interest rates. They also control something that they call their balance sheet. And that's the real action we need to watch. Think of the Fed's balance sheet like a giant piggy bank. During the pandemic, the Fed went on a shopping spree. They bought trillions of dollars of government bonds to pump money into the economy. So their balance sheet ballooned to almost $9 trillion. That's a lot of money that's sloshing around the system. And by mid-2022, the Fed started to do the opposite. They started what they call quantitative tightening, QT, fancy term for they stopped buying bonds and they started letting those bonds, that money disappear. So basically a bond will expire. So if they just don't do anything, the money just disappears. So every month, billions of dollars were being drained out of the system this time. Now, by right now, the balance sheet is expected to be around, by the end of the year, 6.6 billion. So, sorry, trillion. Biden moment, sorry about that. So 2 trillion less than at the peak. So they've destroyed $2 trillion worth of money. Now, why does that matter? Because when you drain money out of the system, banks have less money to lend. They get squeezed. And when banks get squeezed, well, bad things happen. So let me connect the dots for you. The Fed raised rates aggressively. That crushed the value of bonds that those banks were holding. Then they drained 2 trillion from the system. That put pressure on banks' ability to meet withdrawals. When you want money back from the bank, they're like, no, we haven't got the money. And then in March 2023, you might remember that, boom, 3 major banks collapsed in the space of less than 2 months. Silicon Valley Bank, Signature Bank, First Republic Bank. These were not tiny community banks. These were major institutions with hundreds of billions of assets. And the same forces that killed those banks are still at play today. The losses are still there. The commercial real estate exposure is still there. The liquidity squeeze is still there. The Fed never fixed the problem. They put a Band-Aid on it, yeah, and that Band-Aid is starting to peel off as Band-Aids do. I'm going to dive deeper into that and give you some action steps of how to protect and how to benefit from this. But I want to make sure you understand I'm inviting you to something special this Saturday. I'm hosting a free live training. I call it How Wall Street Picks Better Stocks. I'm going to show you the exact tools and the exact strategies that the professional investors use to find winning stocks before they potentially explode. So make sure you sign up for that. There's a link in the description, felixfriends.org/training. I'm also pinning it to the comment section. Now, before we can get into how we profit from this, we need to really understand this. And I know a lot of people haven't got the patience for that. That's okay. You can read the notes I've put out for you, but ultimately I'm just looking at mosquitoes trying to eat me alive here. Let me tell you the story of how Silicon Valley Bank, one of the most important banks in the tech world, went from totally fine to completely bankrupt in 48 hours. SVB, Silicon Valley Bank, was the bank for tech startups and venture capital firms. If you were a hot startup in Silicon Valley, you banked with SVB. They had $175 billion in deposits. Right? It's a serious bank. Now, here's what killed them. Bonds. You see, banks don't just keep your deposit money sitting in a vault. They invest it to earn returns. SVB bought a ton of long-term government bonds back when interest rates were 0. Safe, right? Government bonds, safe investment. Well, that's where they were wrong. The bank was obviously run by Muppets. Here's the thing about bonds. When interest rates go up, the value of existing bonds goes down. So think of it like this. If you bought a bond that pays 1% interest, and then a new bond comes out and it pays 5% interest, well, nobody wants your old 1% bond anymore, right? So your bond loses value. So by the end of 2022, SVB was sitting on 15 billion in unrealized losses on their bond portfolio. That means if they had to sell those bonds, they'd lose $15 billion, right? But they figured, no problem, we'll just hold on to them and time will be the great healer. But then people started withdrawing money, lots of money, and SVB needed cash. So in March 2023, March 8th to be precise, they announced they'd sold a bunch of bonds and realized a 1.8 billion loss. They also said they needed to raise capital. That announcement triggered panic. Tech founders and VCs started telling their companies that they'd invested in, get your money out of SVB now, right? Some sort of FaceTime call or SMS went around. You know, you can think about the big venture capital funders. They were like, this is our money, you better protect it. So 89% of SVB's deposits were uninsured, meaning they were over that limit that the government guarantees, the $250,000. So people had real reason to panic. So on March 9th, one day after that announcement, depositors tried to withdraw, wait for it, 42 billion in a single day. The bank couldn't meet the demand. By March 10th, California regulators seized the bank. It was over. The second largest bank failure in US history. But it didn't stop there, because once one bank failed, people started looking around nervously at other banks, right? 2 days later, March 12th, Signature Bank in New York collapsed. They had 110 billion in assets. The same fatal flaw, 90% of the deposits were uninsured. Plus, they had lots of exposure to crypto, which made them even riskier in people's eyes. So regulators shut them down. They invoked something called the systemic risk exception. Basically, they protected all depositors, even the uninsured ones, to prevent total panic. And then came the big one, First Republic Bank. This was a darling of the wealthy. They catered to high net worth individuals, big accounts, fancy mortgages. They had 230 billion in assets. The second largest bank failure in US history when it went down. Right? Eclipsed SVB, May 2023. Now, a group of big banks, JPMorgan, Bank of America and others, they tried to save it. They put 30 billion deposit into it, but it wasn't enough. Depositors kept fleeing, the bank was doomed, and then JPMorgan swooped in and bought the carcass, which was brilliant acquisition from their part. So they took on all the deposits, all the assets, the government took all the risk, and JPMorgan did what JPMorgan always does, right? But understand this is the United States. 3 banks, hundreds of billions gone in less than 2 months. And the crazy thing, we're still dealing with it. Nothing has actually changed. And now you might be thinking, okay, Felix, that was crazy, but that was 2023, it's 2025 now. We've moved on, right? Dead wrong. Here's why. The problems that killed those banks are still here. Number one, the unrealized losses. They're still there. US banks are sitting on 400 billion of that. Actually, it went to 480 billion. Commercial real estate exposure. Banks, especially the smaller and regional ones, they lend money to people who build office buildings, right? Well, guess what? Nobody wants commercial real estate anymore because office buildings, well, they're empty. Everyone's working from home, right? There's $1 trillion in commercial real estate loans that's coming due this year. The people who own those buildings need to refinance. But they built those buildings in the world where interest rates were 0. Today, they're 4%. They can't refinance at 4%. So you're going to get defaults, which means more losses for banks. But Florida Atlantic University just did a study, and they found that 1,871 banks whose commercial real estate exposure exceeds 300% of their equity. That's the real danger, then. That's where the failures start. So no, we haven't moved on. We're sitting on an absolute powder keg, and the fuse is like literally burning, getting closer and closer and closer. So you got money in the bank. So how do we know which bank is in trouble? How do we know if your bank's in trouble? Let's look at the warning signs. There is an ETF called KRE, Regional Bank. It tracks the performance of regional banks. So they're like the health meter for smaller banks, right? Right now, it's trading at around $61 or something. It's down 5% this year. Big banks, JPMorgan is up like 30-odd%. There's a huge divergence. So the market is telling you we trust the big banks. We do not trust regional banks. Now, some regional banks have shown cracks. Zions Bancorp, Western Alliance, both saw their stocks tank in October because bad loans and fraud and all sorts of stuff. So investors are getting nervous. So the Fed, or rather the FDIC, maintains a problem bank list. And those are banks that have an elevated risk of failure. Imagine this, it's like the most established economy in the world, and there is a list of 66 banks that are at risk of failure. Now, the FDIC doesn't publish those names publicly, but the number they have to publish, and it's up, and that's not good. So if you own regional bank stocks, if you have your money in a regional bank, well, you might want to think about that. Now, not all regional banks are bad. I don't want to cause panic here, but some are sitting on time bombs, and the market is starting to figure out which ones. So enough doom and gloom for the moment? Yeah, I think so. Let's talk about what you could actually do here, because this isn't just about avoiding losses, this is about making money. Every disaster makes people money. First step is make sure your cash is protected. Government insures deposits up to $250,000 per depositor, per bank, which means if you've got more than that in one bank, in one account, you're at risk. Now, if your money is in stocks or in bonds, that's separate. You own those assets, different story. But if you have more cash than that lying around, and I don't know why you would, but some people might, well, spread your money across multiple banks. Right? You can have 250K in Bank A, another 250K in Bank B, and so on. Each one fully insured. Now, there's a smarter solution. You can also use different ownership categories at the same bank. For example, if you're married, you can have 250K in your individual account, 250K in your spouse's individual account, and 500K in a joint account. That's $1 million in coverage of one bank. I would recommend you think about investing that money, by the way. So that's you fixed up this week. Step 2, you may want to consider moving some of your money into safe havens, assets that thrive during banking crisis. What are those? Well, US Treasury bonds. They're backed by the US government, safest investment on the planet, allegedly. A 10-year US Treasury yield is about 4%, which is a pretty solid, safe return. It'll underperform inflation, probably, but Second option, you can put it in a money market fund. These are funds that invest in short-term debt. High liquidity, stable. Again, they're paying 4 to 5% right now. Vanguard has one, which is called the Vanguard Federal Money Market Fund, VMFXX. VMFXX. Yields 4.2%. It's essentially risk-free cash, earning some return. Third option, and this is, I think, where it gets more exciting. Gold. Gold's been on an absolute tear. So gold's trading about that 4,200 or something mark per ounce, 60% up over the year. Why? Because when people lose faith in banks in fiat currency, which is the paper money the Fed can print, they run to gold. It's a 5,000-year-old safe haven, and right now it's working. So how can you buy gold? You can buy physical gold, or you can buy gold ETFs like GLD or IAU, which is very easy exposure. You need to store the gold bars in your basement. Don't need to worry about getting mugged or robbed on the way home. See, it's a sensible way. Now, if you're a real gold nut, you're going to say, I want to earn physical gold. I totally get that. I understand that. And then you're going to have some storage issues, right? Now, my view on gold prices, I think they might flatten for a little bit, but I think they're going to keep going up. And a lot of that's going to do with China and other emerging economies buying a shit ton of gold. So I think as a 2-3 year kind of horizon, I'm liking it. But again, not financial advice. I'm not telling you to buy it. I'm just saying that's the way I look at it. Now, if you want to make real money, you need to be selective about bank stocks. Some are a disaster waiting to happen. Others are real opportunities. So avoid small regional banks with heavy commercial real estate exposure. Examples, Zions Bancorp, Western Alliance, they have issues. You want to avoid those. You could systematically buy important banks, the too big to fail institutions. Think JPMorgan, that would be the king of American banking, right? It's up 33% on the year. They passed the Fed's 2025 stress test with flying colors. Well, they probably rated. So it's a very diversified business. There's no way they're going to go out of business because it would be the end of the world. So it's not going to happen. JPMorgan always says we bank countries, and therefore it's not going to get bust. Citigroup is another one. I think it's an undervalued play. Analysts calling it the dominant pick with potential to double in 3 years. Not my words, analyst words. And they've really transformed their business, cutting costs, returning money to shareholders, and it's pretty cheap compared to others. You may also want to consider Bank of America, ticker symbol BAC, Wells Fargo, WFC, passed the stress tests. They're stable. Now, if you want some regional exposure to banks, because there are opportunities there. The ones with less risk, in my humble opinion, is US Bancorp, USB is the ticker. Truist Financial, that's TFC. Huntington Bank Shares, that's HBAN. These are well-managed regional banks in my humble opinion. They're more diversified, their fundamentals are better. Now, if you want to be really aggressive, and I'm not recommending that, but I just thought I'd include it here for simplicity and completeness, you could sell the weak. So you could buy the strong banks, and that makes sense because they're going to come out as winners. And you could short the losers. I'd be very careful with that because government might step in, right? It might get sold at a price that's higher than what you thought. So look, we've covered a ton here. So let me boil this down to 5 actions you should actually take this week. Action number 1, go to the FDIC website. Use the EDIE tool. That'll tell you your deposit insurance coverage. You have more than 250K and want a bank account, one bank, do something about it, right? 2, you might want to move a percentage of your portfolio, 5, 10, 20%, your choice, not mine, into safe haven assets. If you're in the US, you can open a Treasury direct account. You can buy some T-bills or Treasury bonds or put some money into something like VMFXX. You want safe, liquid capital that can weather the storm. And then 3, you might want to put some money into gold. Gold ETFs like GLD or IAU are the easiest way to do that. That's your insurance policy. You could also put it in the basement. But again, it's an asset that doesn't pay you a yield. This is an asset that in the long run appreciates typically, particularly in crises. And 4, review what banking stocks you hold. And maybe you say, I don't know any banking stocks. Well, do you own the S&P 500? Yeah, you probably own some banking stocks, right? So especially if you have some regional bank stocks on there, look at their commercial real estate exposure. Look at their stock performance. If they're down big or they're showing red flags, you might want to think about that. And then instead, you might want to move that money into something like a JPMorgan or a Citigroup. And then number 5, stay informed. I could tell you to read the FDIC quarterly banking reports, but let's be realistic, nobody actually does that. So you can subscribe to this channel. You can go and download the workbook I made for you in our community, where we also keep you up to date with a lot of stuff. And this is a fluid situation, and no one's interested in a crash when there isn't a crash yet. Well, when there is a crash, everyone's suddenly interested, and at that point, it is too late to prepare yourself for it. This is not happening today. We may be okay for 6 months, right? But we need to stay ahead of this curve, in my humble opinion. And I know it's been a bit heavy, this video. I'm sorry for that. My little geese friends, I shall show you in a second, are saying, lighten it up a bit, Felix. But this is kind of scary stuff, right? We've been here before. Every financial crisis creates opportunities, though. People who made fortunes in 2008 weren't the ones who panicked. They're the ones who understood what was happening, and they positioned themselves accordingly. And you have the same information now that the institutions have. You know what the Fed just did. You know where the risks are. You know where the opportunities are. And the question is, what are you going to do with it? So don't be the person who looks back in 2 years, says, oh, I saw this coming, but I didn't act, right? Be the person who protects your wealth. That's really what it's all about. So come and join me for the live training also on Saturday at 9 a.m. New York time, 2 p.m. London, 3 p.m. Europe, felixprehn.org/training. And if you got some value out of this, then share it with a friend so more people are informed. I wish you all the best and great success. I'm not sure if you could hear these guys, but there are those geese that are making all that racket. I wasn't going to make this video, but I discovered this $4.79 stock, and it's literally powering the next generation of cancer treatment. So it's literally the thing that's, curing cancer. And Wall Street, well,